Thank you, Amy, and welcome everyone to the 41st Annual Eide Bailly Bank Seminar. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you all for the service you provide to our firm and to our clients. Thank you all for attending this virtual event today. My name is Gary Smith, and I'm the partner in charge of the Financial Institution Service Group at Eide Bailly, and I will be your host today. Our motto for this year is community, and we recognize how community banks have brought unity back to their communities across the United States. Whether it is with PPP loans or helping businesses and individuals survive and thrive by providing unwavering commitment to the communities you serve. We are very excited to have you join us today. We would like to give back to you today with an afternoon of content today eligible for up to 2 hours of CPE. Today, the Eide Bailly Bank Seminar has turned from an in-person live event to 100% virtual format throughout November. We appreciate your attendance and hope you join us for virtual events on November the 4th, the 16th, and the 18th, in addition to today's seminar. Visit eidebailly.com/bank seminar 2021 to register. Before we get to our keynote today, I would like to extend a special thank you to Cheryl Knutson and Amy DeGeorge, who have spent considerable time planning and organizing this event. Thank you, Cheryl. Thank you, Amy, for all your hard work. We have time for questions at the end of Dr. Kohl's presentation, so please utilize the Q&A function in the Zoom meeting. I'm honored to introduce our keynote speaker to kick us off this afternoon at the Eide Bailly Bank Seminar, Dr. David Kohl. Dr. Kohl is an academic Hall of Famer in the College of Agriculture at Virginia Tech, Blacksburg, Virginia. Dr. Kohl has keen insight into the agricultural industry gained through extensive travel, research, and involvement in the ag businesses. He has traveled nearly 10 million miles, conducted more than 7,000 presentations, and published more than 2,500 articles in his career. Dr. Kohl's wisdom and engagement with all levels of the industry provide a unique perspective into future trends. Dr. Kohl, over to you.
Okay, well, thank you, Gary, and it is a pleasure to be with Eide Bailly again. And of course, we're doing it virtually. Just a little bit of introduction for you. Last week, I was on the road. Actually, I was out in Phoenix, up in near Madison, Wisconsin, over in Pittsburgh, and then over in Nashville. And but this is my 228th Zoom and webcast. And so I really appreciate the great attendance. I noticed we got 255 participants on here. And the title of my talk, of course, is Pandemic Economics and Agricultural Lending in 2021. But we're going to go out there and look at 2022 and 2023. And so what I normally do is go up and look at the big picture from a 30, 50,000 foot level. And then we'll talk about some of the tools that are going to be very necessary, particularly 2022, 2023 in the agricultural lending field. And then, of course, we'll talk about the championship DNA. So let's get right into it. And one of the things that I would like to discuss is some of the fault lines and disruptors in the US and the global economy. You know, when we look at the C's of credit, all the way from cash flow to collateral to character, I believe there's another C of credit, and it's supply and marketing chain. And these issues for the ag industry, but for the technology industry and the manufacturing industry are not going to go away. And so I think when you look at the art of lending, of course, you'll be looking at your ratios. I really have to say you need to look at your customers and say, how vulnerable are they to supply and marketing chain type of issues? And so in this renewal season, that's going to be very, very critical. The second element that I think we're moving into what I would call a different phase of the cycle. The past couple of years, we've been in the greed cycle, whether it's been in marketing of agricultural products or whether it's been investing. Matter of fact, a number of people have made money because they didn't have a marketing plan or an investment plan. They were kind of in the speculative phase. Now we're going to be moving into the more disciplined marketing and investing phase. And instead of marketing for dollars, we're going to be marketing for quarters, nickels, and dimes. And so one of the things that you're really going to have to look at in the art of agricultural lending, can your customers make the conversion from the greed phase to the discipline phase? And the discipline phase, sometimes that's kind of boring. And so that's going to be very critical in 2022, 2023. It's real interesting, the carbon and green movement. Well, I'm just going to be very blunt. I think we got out ahead of our skis in this. And in other words, we've gone too rapid to the carbon and green movement. And as I'm going to come back and say, it's created a fossil fuel issue. And that is very, very critical to the agricultural income statements and cash flows, but also to the income statement and the cash flow of the households and the general businesses throughout the United States of America and throughout the world. Also, one of the things that's happening while we're bickering here in the United States, Europe is bickering, China is moving full steam ahead. And one of the things is they're moving to economic and military supremacy. They're the second largest economy in the world. They have gone from 2% of the GDP, world's GDP in 1990 to 17% in a matter of 30 years. And so one of the things that we really have to look at is China's rise out there, and particularly in agriculture, because some of the trade agreements that we have in agriculture are going to be up at the end of the year. The more we take on debt here in the United States and throughout the world, the more it's going to have cryptocurrency challenge our traditional currency, whether it's the dollar, the euro, the yen, or the renminbi. And so one of the things that we're right in this transitional phase, traditional currency, cryptocurrency, and again, our Federal Reserve, our central bank, and even China is trying to get their arms around it. One of the things that we've seen nationwide is deurbanization and rural renaissance. For your community banks that are in areas of growing rural community, or the key is to have broadband internet service. One of the things that you're seeing is what? 11% of Americans don't have to live where they work. And so we're starting to see this rural renaissance in certain areas of the country, and it's influencing land values and all the elements that are around a rural area. The other aspect is global demographics. What you're finding is the United States, Europe, and China and Japan, we're an older type of population. Where you're seeing the youth is in the emerging countries, and as citizens become older, they become more conservative in their spending habits. And again, this may come back to influence inflation, which I'm going to talk about. Now, US and government debt, global government debt. One of the things that we now have, worldwide government debt exceeds worldwide GDP. And in the United States, we're 29 trillion. And so as we look at this in an interest rate environment and the tapering back, this could really create some shock waves that could influence the balance sheets and the income statements of our agricultural customers. Of course, we got additional black swans. I've been criticized over the years. I always talked about black swans and they never occurred. Then, of course, COVID came on and that was our black swan. But you're going to see additional bioshocks, magnetic shocks. The more we go high tech, the more we're vulnerable to cyber attacks, magnetic shocks on some of our electric vehicles. So what does this all say? This basically says we're going to be in an environment of volatility in the extremes, and it's going to take a real high business and financial IQ to be able to capitalize on some of this volatility. Now, moving along, let's look at rollercoaster economics. And one of the things in rollercoaster economics, The peaks will be higher and the valleys be lower. Let's go back about 12 years ago. We were in the Great Recession. The coastal economies were really struggling. And one of the things, agriculture was doing very, very well. Why? Because we went from 8% of the corn crop to 30% of the corn crop for ethanol. Of course, we had a weak dollar because of the Great Recession. We had weathers in extreme, we had low interest rates, but the purchasing power parity, and that's what PPP is, of the BRICS and the CIMTs like Brazil, Russia, India, China, South Africa, South Korea, Indonesia, Mexico, and Turkey, it doubled in 15 years. You know what they demanded? Food, fiber, and fuel. So it gave us the longest super cycle ever from 2008 to 2013. And those super cycles are only replicated, they've only been replicated 3 other times since 1910. And then the big question came in 13 and 14. Are we headed for another 1980s? And I want everybody to listen to me on this one. We entered the grinder years, and why we did not have a 1980s was government payments increased. Second, we had some international trade deals. And then third, land values didn't collapse. And one of the things you've got to keep in the back of your mind, as long as we have strong land values and land values maintain, their value, that's 82% of the U.S. farm balance sheet. So by maintaining those land values, we were able to refinance some of our customers to liquidity and to some extent cash flow. Then the pandemic came along. And what happened was governments around the world and central banks around the world basically came to the rescue. I call this era, and everybody asked me, are we in another super cycle? Absolutely not. We're in what I call the steroid era. It's kind of analogous to our athletes whose heads got bigger and their arms got bigger. And so what happened was it's artificial. And so one of the things, I want to put this in perspective, 14% of the world economy, which is 85 trillion, came from a government check, stimulus checks. Then we had China. China became our largest agricultural trader. Why? Because they had to replace their protein complex, particularly the hog industry. And then, of course, we had weather issues. And then, of course, we're still having supply disruptors. But here's what happened. The Fed let the cat out of the bag. Inflation, matter of fact, money and money velocity, which is M2, was at the levels. Think about this, the levels of the 1970s. So we let that cat out of the bag. Now inflation is full center. Now, what comes after this steroid era is 2022, 2023. And I'm just telling you this, it's going to require a high business and financial IQ of your customers and of your bank. The second thing is, as long as our land values hold, we will not have anything like a 1980s. And then critical to the element will be the stance on agricultural trade. So we've got this roller coaster. The peaks are higher, the valleys are lower. Critical in all this analysis is the stability of land values. Now, let's look at government payments as a percent of net farm income. By the way, I just wrote an article today called Hotspots on the Financials during renewal season. One of your hotspots that you're really going to have to look at is government payments as a percent of net farm income. Now, you can see 2016 through 2019, it was, 15 to 25%. But look at 2020, 61% of net farm income came from a government check. It looks like the projections are going to come out about 40% for 2021. And so one of the things about the government payments, the question you're going to have to ask is, are the government payments reoccurring or non-reoccurring? Reoccurring could be the conservation reserve program. Over in the dairy programs, we've got some reoccurring income. That's going to be a very critical analysis. And here's another analysis. Now, I want to bring this right home because a lot of you folks will say this big picture stuff doesn't matter. Well, this big picture stuff can change your financial ratios very quickly. A well-respected upper Midwest banker told me recently, and I've interacted with him over the years. He said his average coverage ratio, term debt lease coverage ratio, was 241%. However, when he took out the government payments, that dropped down to 114%. And that is one of the analysis that your credit analysts really, really need to do. So that's one of the hot spots that you really need to look at on your financials. Now, we've done a number of these Zoom and webcasts, and again, because you were going to have other types of questions in here, I didn't ask any Zoom questions, but lenders' view of the greatest threat to net farm income 2021 and beyond. 1,000 agricultural lenders. Of course, inflating expenses. Number two, supply and marketing chain issues. Three, reduction of government supports. Now let's go to number 4 and 5, trade issues and producers' management ability. Well, we're going to be focusing on the top 3 here, 2022. I believe in the long term, the trade issues and also producers' management ability are going to be much more important for the remainder of the decade. Why? Because $1 in $5 of net farm income comes from international trade. Right now, cotton prices are, oh my goodness, hotter than a pepper sprout, like Johnny and June Carter Cash and Nancy Sinatra and Lee Hazelwood when they did the song Back to Jackson. My contention is those prices, which are high right now, could drop back to the 60-70% range very quickly due to some of the trade issue type of deals. And that's a type of volatility that we could see out there. So the last 2, I believe, are much more important than the first 3, but we got to get through the first 3 to get to the last 2. Then we talked about inflation, producer price, core inflation without food and energy, and then headline inflation. Look what's happened since March. And you know what's happening? And this has got our central banks very, very concerned. It's now sustaining. And one of the things is the graphical approach really shows this. And think about it, we've been accustomed since about what, 2008, with inflation in that 1 to 2% range. And we were talking about deflation. Now we're into this inflation era, and it's really jumped upon us. You know what the major question I'm being asked by banker groups, by producer groups, is this temporary or permanent inflation? If you heard me speak, what, 2 or 3 months ago, I said, maybe temporary, maybe even episodic, in other words, supply chain type of issues. But I'm moving more and more toward the permanent camp. Granted, the Fed has really slowed down on the money and the velocity of money. So that's taken care of. But we still have these shortages, spot shortages created by the black swans, whether it's technology, manufacturing, it's over into fuel now, coal now. And so as long as we have those, you're going to have inflation. Because I want to put this in perspective. The US household has $2.8 trillion of household savings that they were able to garnish during all the stimulus checks. And so what's happening is that's there to be able to spend. The other thing right along with that that really concerns me, if you really wanted to add fuel to the fire on inflation, is US and worldwide consumer confidence. Right now, the confidence of both the US consumer and the worldwide consumer, which drives anywhere from 55 to 70% of the economies, it's not there. And if it was to come back, and if it was there, you would see inflation even double from the numbers we have today. Of course, watch this central bank. This is one of the things you can start to feel for 2022. You can bake in at least 25 basis points, possibly 50 and 75 basis point increase. Also, the bond program is going to change our margins and our margin management. And who knows what the government budget and tax strategies are going to be. Of course, we have nothing yet, and it's going to be very interesting to see where that plays out. Of course, the government wanted $15 minimum wage. They got it. And how did they get it? They extended unemployment benefits and also stimulus checks, created the shortage of workers, baby boomers retired, and people could earn more sitting at home. But I'm going to say this on this webcast, and you might think I'm kind of crazy, but as much as we have a worker shortage today, 2025 to 2030, it may be a job shortage because every big company, Walmart, Costco, even the airlines, one of the things on their drawing board in their strategic planning is to be able to cut the workforce by 30%. So you heard it here first. That's one of the things out there. But I really feel we've got some inflation with us for the next, what I would say, 9 to 12 to 15 months at least. And so again, agriculture is really hit by the inflation bug, which I'll come back and talk about a little bit later. Now, fault lines in the ag economy. If you think about it, many producers in 2020, 2021, I had producers say they had the best year they've ever had, even better than the great commodity super cycle, because you had prices of 2020 and 2021, but cost of 2019. And so the margins were strong. And to kick in, you had the government checks. And by the way, the government checks came with no cost of production. Keep that in the back of your mind. Now, what is ahead of us is this. We're going to have 2021, 2022 costs. For example, we were looking at fertilizer for our farms. We have the dairy creamery, and we have the beef operation. And one of the things that's real interesting is fertilizer costs have gone up, what, 50 to 75%, even if we can get it. Petrol prices are going up. By the way, got to go to Sweden tomorrow morning. And one of the things is we think we've got high gas. They're paying $8 a gallon for their gasoline. And so what you can kind of see is you're going to see margin compression in 2022. And of course, that's going to influence profits and cash flows, but also working capital lines. Also, your working capital lines are going to be a lot higher because instead of needing 200, 300,000, we might need 400 or 600,000 because of the inflated cost. And so this renewal season is going to be probably the most critical one that we've had in a number of years. And particularly the cash flow projections are going to be very interesting. Now, we're going to go from the greed cycle, which I mentioned before, to the disciplined marketing type of deal. Now, real interesting. We did a banker school. I did a number of banker schools this summer. And one of the schools, we actually have producers that stay with us all 3 days of the advanced school. It's really great because you turn around and you say, well, what do you think? Well, we had one of the producers who was in his early 40s. And what was very interesting was this. He told the class, he said, I left $500,000 of net profits on the table this year by following a disciplined marketing plan. Well, the bankers were aghast. And many of the bankers in there, ag bankers, were of 1 or 2 years of experience, up to 5 years of experience. And then a wry smile came on his face and he said, in the 12 years I've been farming separate from my dad and mom, he says, 90% of the time by following the marketing and risk management plan, I made a profit and I bought land in every year except 2017. What I'm trying to tell you is star this. This is going to be a very critical area as you analyze your ag customers for 2022, 2023. And as I mentioned before, and I'm going to say it again, they're going to be marketing for quarters, nickels, dimes, and maybe even pennies rather than the dollars. And the ones that are speculative, those are the ones that could run into issues. We've also seen family living costs creep. And here is the big one on family living expense. It's not the actual family living cost of one family. It's the number of families living out of our farm and ranch businesses, either totally or partially living. It's grandpa, grandma, mom and dad, junior, juniorette, or the kid that comes back and lives in the basement. And this one, you're going to have to watch very, very closely on the family living cost. The other thing is do a cash flow profit sensitivity analysis with a 25, 50, 75% drop in government payments. And again, these are little analysis that I think are very, very critical. The other thing is I talked about supply chain and marketing chain distribution issues. That's going to be there. But let's go to the oil and energy complex transformation. Now, let's go back when 9/11 occurred. The towers went down, the plane went down, it hit the Pentagon. And by the way, I was right in Somerset, Pennsylvania last week where Flight 93 went down. And at that time, the administration said we were going to become energy independent in a matter of 25 years. We did it in 10 years. How did we do it? Ethanol. We did it with fracking. We did it with solar and wind power. It was a very diversified stream, and the United States, became the leading energy producer in the world. Canada, our neighbors to the north, 4th. Mexico, our neighbors to the south, 8. So analogous to the top 10 football teams, we had 3 right here in North America. You know what this gave us? Security, security, security. It was real interesting. During the pandemic, I didn't travel, so I frequented the local convenience store where you all get wisdom. Well, I told the folks at the convenience store, I said, in a matter of a year, you will see a 50 to 60% increase in the price of gas. And I was there the other day and the guys go, boy, you were spot on that, because we've gone too far, too fast with the green type of movement. And so what you're seeing is disinvestment or no investment by the Exxons and all of that of the world in fossil fuels. And here's what's going on. India is now down to 8 days of coal. They normally carry 18 days. China is actually going to go away from the green movement because they fully realize they need coal to keep a lot of their operations going. So you're going to see a lot of upheaval. Now, I want to stop right here. Think about it. Every recession since 1969, oil and energy prices too high or too low, what has happened is they are a lead indicator. Because the general economy, what happens is they watch the gas pump. And you know what's another element? 8 out of every $10 we spend in a farm and ranch business is somehow connected to oil, fertilizer, chemicals, transportation costs. So this transformation is creating a lot of hiccups in our financials. And so while our portfolios look real strong today, those portfolios, because of these big picture issues, can go the other way, very critical. And this is an element we're going to have to watch real closely. Another element is tax and income wealth. We don't know what's going to happen on income tax, but I can guarantee you everyone is going to get taxed, and agriculture will be right in the crosshairs. Of course, we've seen cash rents and farmland values just escalate this past year. And also we've seen a little complacency in producers. I was in Minnesota the other day and one of the producers says, well, I wonder what I'm going to get for government check this next year. And so that's an element. And then the final element is weather and extremes. And if you really look at it, here's what you need to be looking at as agricultural lenders. You better have a close eye on Brazil and Argentina and all the Southern Hemisphere, because they are one of the things, they're in their planning season. And I'm just going to say this right up front. If China, if we have a good year down there, one of the things that will happen is they will go to South America rather than here in North America. And also keep a very close eye on weather in Eastern Europe. Very critical. So these are some of the fault lines that basically say the good manager is going to be able to navigate this. The poor manager, they may have some hiccups. So You got one of your polling questions. Are you still watching and listening? Yes, yes, of course. And so hopefully you are still listening. So I've got that. So now let's look at the long-term fault lines. And the long-term fault lines in the ag economy is China's rise to global competition, but they have made significant investments since 2013 in economies, 68 economies around the world, $1 trillion worth of investment in Europe and South America. And I guarantee you that whole Asian rim, if push comes to shove, they're probably going to go to Europe and South America. Another transformation that we're seeing is this alternative meat and dairy products. Hey, I'm in the dairy business and we have the dairy creamery. It's amazing. I was just at a Kroger store this morning, actually looking at our eggnog products, and it was amazing the number of alternatives to milk, alternatives to meat. This movement is definitely out there. It's going to hit our profitability. And again, the transformation, soil and water health, this is a positive. That's one of the positives the United States has over the rest of the world. So that's a positive out of these fault lines. Global trends, watch China. And watching China, President Xi of China is moving to a theme called common prosperity. And he's coming after people like Jack Ma and all the wealthy folks, give back to the country. Now, there's a mistake on this slide. It's called REAP. It should be RECP. China joined that trade agreement, but also China joined the TPP, Trans-Pacific Trade Agreement. They've joined for membership. It's going to be interesting to see, because what China said, if the United States is not going to go there, we're going to go there. But one of the things we're watching in China, and keep this in the back of your mind, 29% of their economy is driven by real estate. 90% of their households, demographics that qualify for ownership of a home, have money invested in homes. What's happening is we're having a big meltdown in real estate in China. And so one of the things it's going to be interesting is to see how that ripples through the world economy. Also, how it ripples with their military, because President Xi is coming up for a third term. And to develop nationalism, don't be surprised he creates a little scuffle with Taiwan. Keep an eye on that very closely. Also watch election trends. We see California, Canada, Germany, Chile. Those election trends would say we've moved towards socialism. All I want you to do this evening is to watch returns out of Virginia. That's going to see if that trend will be reversed. So watch the election trends. If you're listening to this on recording, this is election day here in Virginia. Will that trend be reversed? And so what you're seeing is the United States and Europe are joining together to kind of counter China. And then, of course, one of the global trends is ESG, environmental, social governance. All the big corporations are going that way. Now, let's kind of move it in here. And we've been on for about 30, 35 minutes. And we've got 289 folks on. Really appreciate the good turnout. What do you need to kind of keep your eye on the radar screen? Well, watch copper prices, most utilized commodity in the world. And the magic number is about 380 per pound. It's currently about 430, 435. That means a growing economy. Okay. Now, the one that you really need to watch is consumer sentiment. Now, this number says 84. That's an older number. But recently, this number has been in the low 70s. Ideally, to have a consumer that is confident, it needs to be 90 and above. And so I watched the University of Michigan study that comes out each month. It came out last Friday at 71. Our consumer is not confident. And to have a robust economy, you've got to have a consumer that's confident here, but also one that's confident in China and around the world. You'll notice that oil prices, one of the things is they're currently between $75 and $100 a barrel. Early 2021, they were 68. Again, this is a critical metric. Another critical metric, you like to see housing starts above 1.5 million. They're currently about 1.6 million. Stock market, you can ask me a question on that, but I will just say it's bubblish. And I'll stop right there. And maybe if you've got a question later on, you can ask me. Now, I've talked about all these trends. Okay, let's go to cryptomania. Let's go to the Graduate School of Banking at Colorado. I've lectured there for 30 years. I was in the second day of class, and all of a sudden, a lender in the back of the room raised his hand. He said he had an agricultural producer come in wanting to increase his lines of credit. Well, what was amazing, what did he do with the increased lines of credit? He went out and bought cryptocurrency. Then 3 other ag lenders raised their hand and said, we had customers do the same thing. Last week, on one of these Zoomcasts, a question came from one of the ag lenders: how do you value cryptocurrency on the financial statements? Never been asked that one, but cryptomania is definitely out there. Of the 503 bankers at the Graduate School of Banking up at Colorado, 23% were invested in cryptocurrency. So one of the things you're going to have to watch is ag lenders, is cryptocurrency, and how do you value that currency? So that is one of the things in the art of lending that we didn't see a year ago that we now see. Well, let's shift gears and talk about the management mindset of the 2020s. This is the science and the art of ag lending. One of the things that I think is really critical is how a producer approaches you. Let's take old producer B. Oh, I wonder if the lender's going to finance me. Am I going to survive another year? Often, they're either that know-it-all or they're kind of the victim, blame everybody else for their problems. Now, are you dealing with that customer, or are you going to be dealing with producer A? Kind of, how do I compare? What are others doing? Long-term thinking. And you know, I've lectured and guest lectured over here at Virginia Tech in some of my older class, or the classes I used to teach. And as I mentioned to them, in school, you get the lesson first, then you get the test. I used to give pop quizzes. In the real world, you get the test first, then you get the lesson. And one of the things that I would just tell you right up front, you can put your customers into 3 buckets. And again, if you've got multiple people listening to this, say you're in a boardroom, say you even got some customers listening to this, I want to give you the characteristics of the greens, the yellows, and the reds. The green customer, these are the customers that are going to grow. They're very adaptive, they're proactive, but they'll follow the 5% rule. Matter of fact, community banks will follow this 5% rule. And what's the 5% rule? You try to be 5% better in many small areas of your business. And one of the things is you'll see that they sweat the small stuff and they get efficient before they get bigger. What's happened this past couple of years, many producers have got bigger before they've got efficient. They know how to plan and strategize, but they'll execute the plan and then they'll monitor that plan. We're going to get some surprises because we only monitor the financials once a year. And we're really going to get a surprise in 2022. Also, they're very process oriented, but the big question I want to ask you as bankers, are you part of their advisory team, either informal or formal? In other words, it might be a livestock consultant, crop consultant, accountant, etc. One of the keys I'm finding amongst the green bucket, these are the people that are going to grow and they're going to do fairly well. They are now have informal or formal advisory teams. Keep that in the back of your mind. Now, the yellow bucket, this bucket's okay. They're successful because they have equity, but they'll have a history of cash flow and profitability problems. One of the characteristics is they'll restructure, refinance about 2 or 3 out of every 12 years. But here comes the bottleneck. It's when the next generation comes back in and tries to do it the same as the existing generation. And that is where you will have your lender risk. I got to tell you a side note, we're seeing a number of baby boomer farmers like myself buying farmland for the next generation. But you know what's happening? They're buying farmland, but there's no transition plan. And boy, that is one of the check marks that you've really got to start watching for. And you really will see it amongst this yellow group. They get bigger before they get bigger or better, and they don't examine their human management horsepower. And they're always looking for the magic silver bullet, next big thing. It used to be hemp here a few years ago. It used to be catfish and then broccoli. I've seen it, folks. There's no such thing as a magic silver bullet. But this group right here, they're still a good customer, but they're risky, particularly when the next generation comes back in. Now the reds. Guess what happened to the reds? Prices came along and saved them, and then the government gave them stimulus checks. So they're going to be around till 2025. But one of the things as bankers, you'll have to start thinking about, should we start demarketing some of these types of customers? So sit down, think about it, and have this right out here when you do your renewal season. Who fits the green, the yellow, and the red bucket? Bob asked me a question, what's going on with livestock diseases? One of the things that we've had some of the swine fever break out in the Caribbean region. It hasn't got up into the United States. So that one right there. And oh, the question disappeared. But one of the things is we right now, the livestock diseases so far are pretty, they've been abated. So let's move on and talk about net farm income. And as we look at net farm income, let's look at 2020. And I use the FinBin data. It's accrual adjusted, and it's in 22 states. Great database. You got your top 20 and you got your bottom 20. That's 2020. But here's something that's scary. It's almost like Halloween. Excuse me. I've got the 2020 data. Here is something that's scary. And what's going on is when you see the bottom 20%, and the bottom 20% made 144,000, that bodes financial problems for the industry 2 or 3 years ahead. We saw this in 2012 when the bottom 20% of any industry, hotel industry, airline industry, restaurant industry, or farming industry and ranching industry starts making money, you're going to have problems, financial problems in 2 or 3 years. And boy, when I saw this, when this data come out early this summer, that one scared me. And the problem is a lot of those profits, of course, are in the form of government payments. Now, here is a tool I want you to take home. Use it in your renewal season. It's the Business Management IQ. And it's basically something that we have developed here 4 or 5 years ago, and we've refined it down. This is our latest final version of it. It's 15 questions that your customer, you ask of the customer, that helps you get crucial conversations, because the financial statements, they don't have the answers, they have the questions. Simple questions like, do you know your cost of production? Do you know it by enterprise? You go on Shark Tank. One of the things they'll ask you is, what's your break even? What's your cost of production? Why shouldn't our farmers and ranchers know that? Goals, business, family, and personal. That's one of the things I like about community banking versus what I call in-box banking with the big banks. One of the things you take time to ask, what are the business and the family and the personal goals? Because what that does, it helps in developing that relationship lending. What's their record keeping system? Do they do a projected cash flow and financial sensitivity analysis? Do they know a few of the key ratios? Do they work with the advisor team like our 41-year-old? Do they have a written marketing plan? Do they execute it, and risk management plan? The other element is, what's their lifestyle habits? Do they have a transition plan? And one of the things that I would just tell you on that transition plan, I've done a number of young farmer and rancher seminars this year, in person actually. And we ask them, what's your biggest nightmare? Keeps you up at night? Well, they'll often say, well, inflation and all these things. You know what the leading one was? Mom and dad, grandpa and grandma will not tell us about the transition plan. They're holding us hostage. That one right there, you can start. Very critical. Observe what they go for as far as educational seminars and courses. Is it production? Is it finance and marketing? University of Minnesota found in a study that the folks that went to a marketing and finance type of seminars were much more profitable. And then what's their attitude? Are they proactive, reactive, or indifferent? Real interesting. A couple of years ago, I was doing a crop and livestock conference and had breakfast with an 84-year-old large animal vet, and he was a feisty individual. Some of you know, large animal vets, they can be opinionated. And he came to my session. I illustrated this business IQ. He came up afterwards, said, "Boy, I enjoyed your session," but he said, "I'm totally disappointed in your business IQ." Kind of threw me back. Well, what's the problem? He says, line number 15 needs to be line number 1, because he said, historically, when I worked with reactive and different people, constantly out there on emergency work, they were looking for that magic silver bullet. He said the proactive people were much better. And he says, they aren't going to do the first 14 if they don't have number 15. That is your art of lending right there. Now, I had to respond to him. I says, well, I saved the best for last. If you have your customers fill it out, what are 3 areas to continue? What are 3 areas to improve? Never more than 3. It's like covenants. Never more than 3, because it becomes too overwhelming. This is a great tool to screen for attitude. I had a banker and a community banker in Mankato, Minnesota. Customer comes in, wants a restructure refi. And he said, well, fill out a projected cash flow and, fill out this business IQ. You know what the customer said? He had kind of had an attitude. I can't predict, what the future is going to be on these cash flows. And he said that business IQ, that's just that Kohl, that academic guy. I don't have time for him to do that. You know what the banker said in the back of his mind? He's going to have to find another lender. And if you do have your customers fill it out, make sure they fill it out separately, because you always got that D dominating personality. Boy, this is a great tool to, particularly if you've got credit analysts or loan committee teams, particularly in community banks. This is a great tool to, take what's out there in the field and kind of take it back to those teams as far as management. But here's the kicker. The 3 areas for improvement, this gives the customer buy-in. They have to develop the plan for improvement. Now, this is an actual farm customer that actually filled this out. We've worked with them the past year. And what was real interesting, the husband gave himself a 53 score. He can't get a 53 score. He gave him a 4 score as far as attitude. Well, you'll notice the daughter, the wife, the CFO, and the lender, they've marked them down. But it was very nice to kind of see where they thought they should continue, where they should improve. And what's real interesting, this was just the quantitative scores, and you can kind of see it. Don't be worried if you're ag banker, you'd say, well, the banker was a lot tougher on the customers than they were on themselves. Normally, I find that flip-flop. But by the way, the customer that gave himself a 53, he eventually got restructured, refinanced through the lender, and he said, every customer needs to fill this one out. That was kind of a testimonial, because he was a little resistant at first. We actually did a study last fall and last winter, and we looked at the business scores, the IQ scores, and various financial metrics. Here's the long and short of it. The people with the bottom third scores carried 3 times more debt, and often it was restructure, refinance debt. When it came to profits, ROA was significantly higher with the top third scores versus the bottom third. And look at your net farm income. You can see significantly higher. But then zeroing in on a couple of ratios you all use, the coverage ratio for the top third, it was 114%, not stellar, but still positive. Of course, we were looking at data from 2016 to 2019, bottom third, 10%. They were basically a restructure waiting to happening. And then, of course, the operating expense ratio without depreciation interest, 32% margin with the top third, 10% margin. And by the way, it was statistically significant. So that's a tool hopefully you can take away from this webcast that you can use in renewal season. And again, it creates conversation, but it gives you more of a quantitative look at management. Now, here's one of the things you're going to have to be really careful on your ratios. Right now, credit quality is good. A lot of the ratios are in the top of the cycle. And I find this is my 5 decades working in ag lending and working with you as ag bankers. I find that your stoplights will kind of change whether you're in the top of the cycle and the bottom of the cycle. I just give you this illustration out here. And again, I'm not going to go through and explain it, but I will see a lot of variation from top of the cycle to the bottom of the cycle. So again, sometimes you have to have stretch in the waistband on some of these financial ratios. By the way, if you're trying to troubleshoot and turn a customer around, it's about what I call capital turnover and margin management, earns and turns. You either improve efficiency of the assets or you improve margin, or you do the combination of both. I just gave you an example. And oftentimes when I'm working with a business trying to turn it around, I focus right in these 2 areas. In other words, how do we turn our assets quicker? And then how do we increase our margin? Well, let's bring it home. I want to leave a couple of minutes for questions, Gary, as I turn it back to you. This really relates to a community bank. And I'm pro community bank out there. One of the things about a community bank, they're authentic. The ones that have the championship DNA, they're authentic and they're genuine in their purpose. And here's one of the things, they're very good at meshing vision and brand. The vision's how you see your business. The brand is how the customer sees your business. That's very, very important. And there's a lot of connectivity beyond and meaning beyond the paycheck. In other words, it's a higher calling to serve the customer, the community, and the country, kind of that unity that Gary was talking about a little bit earlier. The other thing is they look at incremental growth. And in other words, does the customer kind of fit the vision and the values of the business? And, I had a community banker tell me this one day. He says, you take care of the customer, you're going to be profitable. And I see that as I kind of worked with the banking industry over the 5-6 decades. You share your financials throughout the institution. I used to teach with this gentleman at one of the banker schools. And he often said, if you go to my community bank, you can walk in there and everybody will tell you what the ROA was. Well, I took him up on it, and his bank was up in Wisconsin. And sure enough, I'd stopped by randomly a couple of times, but then I stopped after hours one night. The janitor was there, and I asked you, what's the ROA? Sure enough, the banker was able to do it. But one of the things is this gives that buy-in throughout the institution. Another element is, remember, change occurs bottom up, not top down. I'll give you an example. In the 1970s, the government tried to invoke the metric system on America. Well, we still don't have the metric system. See what happened? It was top down rather than bottom up. You want change in a business, it's got to be bottom up. Here's a big one I'm a big believer in. You hire for attitude, train for attitude, or train for aptitude, but you also have another A called accountability. And that includes family members too. And training and education is an investment, not a cost. And that's one of the things I've got to give a shout out for this organization, a shout out. Most community banks here will put money aside for the investment in their people. And you're going to have to do that, particularly with the younger generation. And one of the things that I've found is you often will find community banks have an educational component. It could be one-on-one with the customer. It could be industry-sponsored events. I do quite a few of those events with producers and businesses. And then one of the things is they always invest back into youth, whether it's 4-H, FFA, manners programs, or it could be any programs in the community. They've really got a youth coefficient. Here's the other thing. They're very consistent over time, conservative in the good times, that's right now, courageous in the tough times, but consistent all the time. And boy, one thing I'll find about community bankers, they can take the complex and make it simple. And one of the things that I really find is there's no saying, if you can't explain it over a simple napkin, it's probably too complex. Well, Gary, I've got 57 after the hour. I wanted to leave 3 minutes for questions. Are you still watching? Hey, Gary, I hope they're still watching. And it says, yes, of course. And I kind of like that question. We should have asked them how tall I am.
I know, right?
As a matter of fact, we could put that one in, but some of them have already seen me. Well, Gary, is there any questions? I didn't see any questions. Can I just share with you? I got asked this question by lenders while I was on the road. Coming up on this renewal season, you've got to look for hot spots on the financials. How were the profits made? And how were they distributed and how were they spent? Because a lot of our farmers and ranchers outside the drought areas were pretty profitable. And particularly, you got to watch that government payment line. I think another thing that needs to really be focused on is that top half of that balance sheet, working capital lines of credit. Did they pay down accounts payable? And I'm saying, did they? That's your customers on out there. And I think one of the things is that BusinessIQ can really be a tool that they could use to open up the communications, which that's one of the things I like about community banks. For the most part, they're not box lenders. They're face to face, or they're very, very open to communications with the customers out there. So that was some of the points that I got last week as I was out there working with ag bankers and ag lenders last week. Is it fair to segment producers into third? Over time, want those in the middle fall to the bottom? That's a really good question. Hey, Bob, very, very good question. What I find is about 60% of the time to 70% of the time, the top third will stay in the top third. There'll be 30%, they'll fly down to the average or below average when they get hit with a macroeconomic event like weather, or maybe they have a tragedy in the business. What we'll find is on the average, about a third of them will move up to the top third. The other 2/3, if they don't have a good transition plan, what they'll do is gravitate down toward what I call the orange area or the red area. And so that is a very, very good point. And by the way, what I'll find is, Bob, on the top third, they will usually score on that BusinessIQ probably about a 35 toward 50. The bottom third or the average third, they'll be in that 24 to 34 range. Hopefully that gave you some insight on that one there. And again, when the people do fall in the categories, it's usually the macroeconomic factors or a major change in the business. Well, Gary, I got 59 after the hour, and I don't want to overdo my welcome.
Well, Dr. Kohl, as always, we appreciate you joining us today. Just to let everybody know, we will put Dr. Kohl's presentation out on our event app. We'll have that done after these presentations today. And again, Dr. Kohl, we always appreciate your insight for our ag lenders out there. We definitely appreciate your time today.
Well, Gary, and I just got a question from Ella. Any ideas reaching out to the young and up and come next generation? Can I tell you, Ella, they love education. And I do about 20 events, multiple day events. And I guess I look like their grandfather and they'll actually listen to me. But if you or some other organizations can get together and put on maybe a day or two type of event, it'll be the best investment you'll ever make. And it's an investment out there. Ella, thanks for that question. Gary, I didn't mean to cut you off there, but Ella popped in with that question. And guess what? it is now top of the hour, as they would
All
say
right.
on radio. And hey, thanks for having me on. Really enjoyed, and I'm very impressed. 293 participants here today, Gary.
And they
That's
all stayed on, Dr. Cole,
I
so that's
know.
good, right?
I know. And again, I wish you well. And hopefully I'll get a chance to see you all in person out there. And so as the sun shines here and the sun shining in Phoenix, best to all of you.
Thank you, Dr. Cole. We appreciate your time. Thank you again.
Thank you.
We will transition now into our next presentation. Hopefully everybody will stay on here, and we're in the process of getting set up here with our next group. Going to move into our CECL presentation. So we've got Brian Finley and Darrell Lingle with Eide Bailly, and I'll turn it over to them.
All right. Well, good afternoon, everyone. Thank you, Gary. And yeah, it's always a tough act for Brian and I to follow up with CECL after Dr. Kohl. And I know when I was going to college at Augustana College down in Sioux Falls, my accounting instructors were never as interesting as Dr. Kohl. So we'll try. You got a couple of accountants here. We'll try and get through CECL, and I know Brian's done a number of these different seminars, and just kind of an FYI to the attendees that are out there right now. This presentation will be similar to what you probably heard a couple of weeks ago, that when Brian presented out in California, and then also last August, Bank of North Dakota invited Brian and I to speak on CECL. So it'll be a lot of the same information that we will cover today. But hopefully, there'll be some tip or nugget that will come out from what we're going to present and as we work through CECL. So today, some of the things that we want to make sure that we touch on as far as the discussion topics, we'll go through the effective date, the recommended timeline. We have some different timelines where we hope that your banks are moving towards as far as the implementation with CECL. A CECL overview, very general. Brian will get in maybe more of the blocking and tackling as far as the model comparisons. And then also, of course, preparing for your auditor and regulator. And just kind of a note on that, the AICPA National Convention was held back in September. There was a great line that came out from one of the breakout sessions in regards to your CECL model. And it's really the tone from the regulatory agency is don't worry, but the tone from your auditor and the PCAOB is worry. So, hopefully, I know the regulator always carries the big stick, but I know as auditors, we're really taking a look at 2023, and, it's going to be a big shift, both on your side as far as the calculation, but then also how we audit the model as well. And then hopefully have some Q&A as well at the end. So just encourage people as questions come up. Gary will be watching for any of the Q&A that pop up. Don't wait till the end. You can jump right in and we'll cover those questions as we work through it. All right. Yeah. As we take a look at the CECL effective dates, this standard has been out there. Boy, it seems like a long time. I think it was initially issued back in 2016. So it just seems like it's always been lurking out there. I know that everyone's been maybe hoping that it continues to be in perpetual delay. Unfortunately, we're getting to that point now. We're at the doorstep of the effective date. Being effective on January 1st of 2023, when the pandemic hit, that was pushed back to allow a little more implementation time. But what's going to be interesting about this standard as well, a lot of the standards are at the end of the year for become effective. Your interim reporting periods, your call reporting periods, still under maybe some previous form of GAAP. But with CECL, it will be effective beginning right away in 2023. So with that first call report in March of 2023, you're going to need to have your number ready to go as far as that CECL reserve at that point. And just from the polling questions, it looks like predominantly that's where the bulk of the attendees will be in that group that's going to be adopting as of January 1st of 2023. So it's been out there for a number of years. I wouldn't anticipate unless something unusual happens, it took a pandemic to delay some effective dates. That's probably what we're looking at again. It's going to take something significant like that. So I think for all of us, let's just hope that we stick to the January 1st, 2023 effective date. Next, just kind of touching on some of the recommended timeline for implementation. The polling question was great because we've got a number of people or a number of attendees that their banks are either haven't or in the process of selecting, a methodology, or if they're going to go to a third-party vendor. Some, have chosen their vendor, working through the process, and others have already adopted. So really taking a look right now, 2021 or earlier, really should be where your banks are at right now. Have your internal team, a cross section, like Brian mentioned. This is really, it's not just an accounting function. It's not just something for the lenders. It's really a cross section of everyone that's at the bank being a part of this CECL process. So hopefully you've selected that team, went through the process of determining, are we going to try and do it from an Excel based model, or are we going to look to a vendor? I know the Feds come out with their scale model, so that was something new that came out in 2021 as well. So that's thrown another twist into it. So hopefully we're working through that process. Policies and procedures, that's going to be another significant item that goes along with the CECL adoption of the CECL methodologies too, is it's going to revise a number of the policies and procedures that are in place. And then also your internal controls, not only those banks that would be over that $1 billion threshold that have to have the auditor's opinion on the internal controls over financial reporting, but also just need to have those controls set in place of how the calculations going to be made on a quarterly basis, working through the process of the validation or the check each of the quarter to ensure that the calculation is appropriate. We don't have an error in the calculation. The information that we're using to determine or that flows into the models is valid. We've done that completeness check. It's going to be a lot of moving parts that we need to make sure that we're getting our arms around as we're closing in on the end of 2021 for those banks that are still, maybe not even to this point, really need to start hitting the gas pedal to get to that spot in 2022, where we're really looking at 2023 for the implementation. I think as we move into 2022, I think that the last bullet point is probably going to be the most significant. Is really, it sure seems like some type of a validation that needs to occur during 2022 before we go live. We're going to want to be able to run parallel to ensure that we know what the impact is going to be. I mean, we've as CECL was initially exposed out from FASB. I mean, a lot of different estimates of what was going to happen with the CECL reserves as a result of CECL. Gosh, we were hearing 50% increases, 75% increases. Even in some seminars that we were at, it was 100% increases to reserves. I think a lot of that has maybe been pulled back in now as we've gotten a little bit closer. With the large public filers that have had to adopt CECL, we're starting to see some of the, what's the effect to have been. Of course, that was during a pandemic, but we've also seen it kind of slide out of the pandemic as well. So we've seen, how CECL will, react into the varying different stages of the economy. So I think we'll see a lot of different fluctuations that occur and volatility that'll occur through CECL as the economies do change. So a lot of things we're just going to need to make sure that we have most of 2022 to be able to take a look, run parallel, know what to expect once we go live as far as the financial impact, and then also to leave enough time for any type of a validation to be performed to get those results back, and then implement any of the recommendations that are needed. And then, of course, 2023 will be up and running at that point. So whether we like it or not, it's right around the corner. Brian, anything to add as far as the timeline to implement?
Well, the other one I'd want to point out is if you're, depending on your size, your institution, and your audit requirements, you may, if you know what your CECL impact is going to be, then you should be disclosing that impact. And if you're disclosing what the impact of that accounting standard is going to be, then there would be an audit requirement if you need to be audited as well. So you could be looking at a 12/31/2022 number being audited in the financial statements. So just to throw that out there, you may have your auditor looking at the number before you get into 2023, even if you haven't fully adopted it. So be prepared to work with them and answer questions and get on the same page with them sometime during 2022 for what your approach is going to be on CECL.
No, great point with that, Brian, as well. So yeah, just a quick CECL overview, very, very basic math formula equation accountants. We love math, so we can put it into a formula like this. I mean, just kind of to break it down. And as you're going to see, I mean, a lot of the pieces as far as the calculation to CECL really don't deviate greatly from the incurred loss model. As we talked about, we started with the unadjusted historical charge-off experience. You know, that's similar to what we have right now with the incurred loss model. We take a look at the qualitative adjustments. You know, under the incurred loss model, we do have the Q factors that we consider each of the quarters as the allowance is being calculated by the banks. What's the most unique there is in the parenthesis, the forecasting. I think the forecasting piece is probably going to be the significant hurdle that we take a look at for our banks as they're determining, you know, for each of the different pools, what's the appropriate forecasting attributes that they're taking a look at, how can they be supported? Are we able to go down to a local, more localized or statewide granular level as far as forecasting information, or are we going to need to more rely on what's occurring out on a national level? So a lot of those decisions that need to be made as far as the forecasting piece and ensuring that it's supportable, that it's going to be those items, those forecasting pieces that are going to be available each quarter as we go through our calculation. So it's going to be, you know, I think that's going to be one of the pieces of information that really needs for that group, that CECL team at each one of your banks to be considering of what is the most appropriate forecasting variabilities that we're going to have to use for our model. And then finally, the loan category balance. So you can see, you know, from the CECL overview, the calculation or the math, you know, there's not huge differences, but there's enough differences there that, you know, we need to make sure that we're getting started as well. And also probably the terminology change. And this is something that's going to take a lot of bankers, probably a lot of auditors as well, as, you know, the allowance for loan losses, the ALLL is going to go away and be replaced by the ACL, the allowance for credit losses. So as you start to have your auditors or your regulators talk about your allowance for credit losses or ACL, just know that's really what's replacing the ALLL as far as the terminology. So next we'll take a look at what's new under CECL. And so what's the changes under CECL? So we're taking a look at what are expected losses day one versus waiting for the loss to occur under the incurred loss model. So if you want to really think about it, the incurred loss model is more focused on an income statement methodology, where the expected loss is more of a balance sheet, day one type of a methodology. We're going to record what we feel as we close a loan, what the expected loss would be on the life of that loan. I think the second bullet point is one that maybe's flown under the radar. We don't see a lot of banks that are holding held to maturity securities any longer, but we do run across that from time to time. So in those cases, CECL does apply to held to maturity securities as well. And you may just think, well, you know, that's a slam dunk. You know, there's no loss on our held to maturity securities based on the type of portfolios we have. But you're still going to need to go through the gymnastics or the math and show your work to support whether there's no reserve. So we wouldn't anticipate with the type of portfolios that we're typically seeing in our community banks that there would be an ACL that would be allocated towards the held to maturity security portfolio, but you still need to go through that process. And then the last bullet point as well on the purchase credit impaired. For any of you banks that have done any type of M&A work, you know, the purchase credit impaired loans that come over in those acquisitions. Now that's going to be replaced with the purchase credit deteriorated assets. And there will be a change that goes along with this. What, you know, under the PCI method, there was, you know, essentially under the acquisition, you know, loans came over at their fair value. There was no allowance for loan loss that was built into this, into those acquired loans, whether they were performing loans or the purchase credit impaired. Now with the purchase credit deteriorated, there will be an allowance that will be set up on day one for those purchase credit deteriorated assets. And I know from the national conference, some of the regulatory agency accountants, chief accountants, you know, they don't necessarily agree with or like the day one accounting that goes along with the PCD. So just kind of stay tuned with that. We'll see what happens, but that will be a change. And I think, you know, that was one of the selling points that FASB maybe had, and they knew there was going to be some complexity with the CECL model versus the incurred loss model as far as just your general portfolio. but they felt that maybe this helped to clean up maybe some of the questions as far as the acquisition accounting as we get in, formerly under the purchase credit impaired, now with the purchase credit deteriorated assets. Brian, any comments as far as changes under CECL?
No, I think you hit the big ones. And honestly, a lot of this stuff like the PCI to PCD, you could probably spend 20 or 30 minutes talking about it. And if you search online, there's going to be papers that pop up with 10, 15 pages in length. So I'd say our talk today is going to try and point out things that people should keep in mind. And if something like PCI loans is important for your bank and you have a significant number of them, you should do some research prior to implementation and maybe reach out to us if you have further questions. But okay, that's it.
All right, no, that sounds good. And then, next couple of slides, we talk about economic trends and forecasted data. Like we mentioned a couple of slides earlier, I think the forecasting piece is going to be the one that maybe the banks struggle with the most of what really fits for their bank. I mean, as we look at the economic trends, I think that the first bullet point is one really to keep in mind is that, the economic trends should match the risk pool being analyzed. They may not be the same for each one of your pools. So you need to really take that step back and really have some good discussion within your CECL groups at the bank of does the economic data that we have for, maybe the bulk of our pools really fit for all of them. Maybe there's some unique lending area that the bank is in that should have some different economic data or trends to take a look at more closely aligned with the pools that are being analyzed. We talked about trying to get the data or the economic trends, as close to what's really occurring at your bank and at your local level. Of course, that's the best information that would be possible of knowing. To be able to do the forecasting is knowing those economic trends that are at a local or statewide level. But then the challenge becomes, how do we validate that information for when those regulatory exams occur, or if you have an external audit, when your auditor is asking about how did you validate, that data that supports the economic trends, and so really to take a look. So, is the work that goes in to analyzing the economic trends or the forecasting at a much lower level or more granularized level at the local or statewide level? Does it really give you any better information than maybe what's available nationally or regionally? So maybe that's I think is going to be a big piece to this, is just, again, the forecasting, identifying what you're going to use, taking a look at the forecasted data on the next slide. I mean, I think there's 3 items here that really jump off the page at me. The first one, the FASB requirement, reasonable and supportable. We're going to have to make sure that we can support the data that we're using as far as each one of the pools that are included in the CECL calc. Why it best fits for your bank. And then the third one, we're gonna have to do some inferences based on historical and current trends. So it kind of runs maybe counter to the first bullet point, but we know that we're gonna have to maybe massage those numbers a little bit to fit, in each one of our banks. Some of our banks are a little bit more rural, some are maybe a little bit more urban. The urban impact, maybe you can look out to some of the SEC filers, may more closely align with your portfolios, and it may be a little more challenging for those that are in a more rural area that are more ag based. So going to have to take a look at those trends and historical data and make sure that we're massaging that data to a fit with our loan pools and our portfolios. And then finally, the documentation. The documentation, document. I think that's really the key piece to this as well. Is making sure that we're documenting our conclusions through a narrative. I mean, it also, one side on the bank, it helps to leave the tracks that are necessary out there when there's transition at the bank, so that the next person can pick that up and be able to understand, where we started and where we're at currently. But then also, again, like I say, to make sure that as you have a regulatory exam or if you're under an audit requirement, that your examiners and your auditors are able to take a look at your conclusions, how you develop those conclusions, and then be able to have good discussions about your model and your methodology at the end of the day. Next, just wanted to touch on just quickly on some disclosure takeaways. As for those that have financial statement requirements, it's not going to be as simple as just an overlay of what you're currently disclosing under the incurred loss model. There are some changes that are going to occur with the adoption of the CECL methodology, ASC 326. What I've been recommending to the bank clients that I work with is, to maybe just do some dry runs. Once you have your methodology, you're running parallels, go through and do some dry runs as far as the disclosure, especially as you get towards the end of 2022. We're going to have the annual requirement in 2023, but maybe at the end of 2022, you get done. Once your audit's done, taking a look at, okay, now as we flip the calendar, we're in 2023. What's going to change with our disclosures? What's our allowance calculation look like? Do we have all the pieces that we need to be able to complete that disclosure appropriately? And then work with your external auditor. That'll be a great time. The earlier you can get started, the more lead time that you'll have as far as any of those tweaks that need to be made to the disclosure. Plus, it's an open book test. There's a number of SEC filers, large SEC filers that have went through this process, the adoption process. Take a look at their 10Ks and take a look at their financial statements that are included in the 10K. Also, Crowe Horwath. I'll go to another accounting firm. They've got a publicly available set of illustrative financial statements, out on their website. I'd encourage the banks to be able to pull that down and be able to have a good roadmap as far as the disclosures that'll be needed. They do a great job of laying out what's required for a public filer, and then what's required for the non-public as well. So just know that that's going to be a significant change as you're planning your implementation process in 2023. So next, I'll turn it over to Brian to talk over some of the different models that are available out there, or methodologies. One final piece is Brian is working through this, just to keep in mind. This was at the AICPA National Conference as well. I think this was a great quote. Build it right, build it once, update quarterly. So with that, I'll turn it over to Brian and talk through some of the methodologies.
Sure. Yeah. Please ask questions as we're going through this as well. I know we've had a few come in. The most recent one's a good one, asking about Q factors, and if you need to have a PhD, be a PhD in economics to be able to figure that out and what it should be. And I think you'll find that depending on the model you pick, the Q factors and the importance of the Q factors will change. Because the Q factors, you're attempting to capture things that aren't already built into the model. So we'll talk through a handful of different model options and what the Q factors might be for each of those. And some of them are easier than others. So selecting a model service provider or a model that you can, like Darrell said, there are some that you can do in Excel on your own, and others are very complex and require thousands of calculations to be done behind the scenes. There's pros and cons to each, and so there's not really a one size fits all. It really depends on your organization, weighing those pros and cons, acknowledging what the pros and cons are, and building a program that's best for your bank. Common approaches that we see, and these are ordered by complexity, really, or ease of use on management's end, at least in terms of the initial calculation. So scale, that's the tool that the Fed just released in July. They just recently put the data out for it. So you can look at their website and pull down their tool. It's a pretty simple, straightforward Excel calculation, and we'll talk about that a bit more. The next one on the list is the weighted average remaining maturity, or WARM. It's more complicated than the scale method, a little less complicated than the discounted cash flows. They've taken some shortcuts on some of the assumptions to make it so the calculation is a little easier, but still gets you in more or less the same place. And Bankers, Caddy, Informa, those are a couple service providers that we've seen doing those. And the cost of a service provider to run the warm calculation is not too cost prohibitive. Where next on the list, discounted cash flows. These are much more data intensive calculations, require a bigger fish to do the calculation. So Moody's and Abrigo SageWorks are a couple that we see pretty frequently. And these lists of who does these, by no means all inclusive. I know there's a lot more out there. I was just throwing a few examples that we've seen through our clients. And then beyond that, others, we won't spend much time talking about this group because frankly, most of them require a lot of own bank data, and community banks just don't have that. The data there, you're generally having to get information from call reports from other banks so that you've got a statistically significant amount of data to work with. And that limits then what you can dig into, where if you're a JP Morgan, you've got millions of records and all kinds of different fields. And so you can do some of these other calculations that were thrown out in theoretical standpoints, but aren't really applicable for a community bank.
Yeah, Brian, I know that I think when the scale method was, when the Fed had their webinar, I think there was kind of a rush that was going to be the answer. But I think, like you'll probably get into, there's some nuance to that too, that it may not be the best solution for some of the smaller banks.
Yeah, it's the easiest solution. Whether it's the best or not, I think depends. You definitely need to acknowledge its shortcomings. And yeah, interesting, the Fed put it out. I was talking to some bankers out in Oregon actually earlier today, and a couple of them were asking about this tool, and they said that they had reached out to their regulator, the OCC, when it came out, just to get their feedback, and they kind of gave they didn't give it a thumbs up, that's for sure. They didn't say no, it's not going to fly. They said we'll wait and see, but it was a pretty tepid response. So I think scale is, we'll talk about it more here, but it's certainly something to consider, but not necessarily it's not a regulator approved. You use this, you can't have any fault found type of calculation. And so what it does is the top row there is the formula that Darrell showed earlier, your basic CECL calculation. What the scale method is doing is taking, kind of cheating off of the big kids homework. It's taking the CECL reserves from the larger banks that report on this form RIC in their call report. And so banks of $1 billion or more, and the Fed pulls data for $1 billion to 10 billion as their community banks. So it's taking the actual reserves for those loans, and then you would take those loss rates or reserve rates and apply them to your loan balances as your starting point. So your starting point is the ending number calculated for the other banks that you're calling your peers. So embedded in all that are all the Q factors and everything else that these other banks are doing to get to their final number. So the rub would be that to come up with a good number for your institution, you should back out or have a Q factor to account for differences between your organization and your loans and theirs. Another one of the pitfalls I see, especially talking with a bunch of banks and a lot of Midwest banks on this call today. And if you're an ag lender, or if you've got a pretty specific portfolio, this form RIC is not all-inclusive. It doesn't have all the call report categories. It just has the handful here, so 4 or 5 loan categories. And so that's what your starting point would be, looking at loss rates in those categories. And if you've got a bunch of, I don't know, ag real estate loans, you probably then have those lumped in with your commercial real estate loans. And you'd be looking at real estate losses in those buckets and trying to extrapolate them to your ag real estate loans. And whether that makes sense or not, I'm not sure. But there's certainly a difference there, and something that you'll need to consider if you're going to be using scale. The Fed's call, which is available if you go to their website, if you just search Fed scale, you can listen to their talk that they gave. And they mentioned as a Q factor, comparing your own historical losses to the historical losses that are in that peer group, and then having an adjustment from there. So that's one of the many things that you could have for a Q factor. And the pros and cons of this really, pros are that it is a very straightforward, easy calculation. You're just starting with an ending reserve number and then applying it to yours, and then adding a Q factor on. So it's pretty easy to do, easy to understand. The cons are that if you're $1 billion or greater, they've said that you aren't allowed to use this, because then you're kind of using your own data at that point. And yeah, it's got quite a few cons to consider as well. It is free. I think if you're a bank that's smaller, more limited distribution, don't have an audit, maybe if you're just getting a director's exam. And I think you probably want to, if you're considering scale, you'd want to play around with it and see what kind of calculation you're coming up with, versus what you've got under the incurred loss model. And is that something that you're going to be comfortable with? And will you be comfortable down the road when the economy turns around and all of a sudden there's real estate losses in banks in New York or California that are then driving changes in your allowance? Because that definitely could be something that happens. So I think if you're considering scale, just make sure you're ready to answer some of these questions. And depending on who your regulator is, I honestly have no idea how much they're going to push back or what kind of questions they'll have. But I do know that I haven't heard from anyone that it's all light or all signals are good to go. I don't know, Darrell, if you have anything else you'd like to add on scale.
No, I think that, Brian, you kind of hit it. There's a lot more cons. Like I say, I mean, after the webinar, I think, at least a lot of the smaller community banks that I worked with, I mean, they thought that was going to be the solution. I think the free piece of it was probably, a major portion of that consideration. But I think, some of the cons are starting to surface and bubble to the surface a little bit more, because the ones we work with are more of a, rural ag-based bank. So it's going to be a little more challenging taking that data that's collected from the large public banks. Does it really fit? And how do you manage those adjustments to that data?
Right. Yeah. And right now the data the first batch of data that they put out there doesn't have some information, like it doesn't have the state or anything for the bank. So you'd have to do some work to maybe be able to identify some peers that you would consider peers, and not just every bank that's in that size range. And it's going to be a little harder to play around with the numbers before your go live date, because the entities that are public or the entities that have that information published out there right now are going to be predominantly public banks that would fit in the $1 to $10 billion range, because those are the banks that have adopted so far, and the rest won't adopt until 23. And there's 1/4 lag on when the data is available because it's coming from the call reports. So all things to keep in mind. Definitely something that is going to be the right solution though for some banks. So with all these, they all have pros and cons. The warm method, this one is, I think, likely going to be used by quite a few of our banks. What it does at a high level is it takes the annual loss rate, and at a loan level, you take your annual loss rate and apply it each year to that loan as the loan is paying down with repayments and prepayments, and you add up all of the losses for that loan, and then you've got your lifetime historical loss rate for the loan. So it's a calculation that makes sense. The trick is, what is your prepayment speed? Because if you're starting with your annual loss rate, how long those loans are out there and what the balances are going to have a huge impact on the amount of reserves that are calculated. Pros of this one, it's pretty easy to understand. If you're comparing it or contrasting it to the scale method, you know what's going into the calculation. You can kind of walk through it versus you're just starting with the end result of other banks as your starting point. The calculation isn't too complex. Everyone can understand it when you drill down into it. The pure loss data is, again, something that you can use. So the service providers that that help banks with the warm method are pulling loss data from call reports. And so you can pick the 50 banks that are your size that are within 100 miles of you, or whatever that number might be, and then use all of their loss history to help calculate what your reserve should be. Up and running quickly, that one we haven't talked about yet, but some of the more complex methods we'll talk about next can take a pretty long time. With the warm method, some of these service providers can have you up and running and getting you running parallel and looking at numbers for your organization in a matter of days, where some of the discounted cash flow vendors, you might be 6 months to get to that point. And the backlog is starting to fill in with them as well, because there is quite a bit of work, and there's a lot of banks that are, or like a lot of the banks on this call today, that are still deciding who to go with and starting to work towards adoption. And this method is inexpensive as well, at least relatively speaking. The cons that I have for this one are the prepayment remaining life, challenging to calculate. And I think especially now with everything that's going on in the interest rate environment that we're in, if you're looking at prepayment speeds from the last 2 years and you're applying it forward, well, does that really make that much sense? Or are those loans really going to be out there longer? Because you probably would expect fewer prepayments as interest rates start to hopefully increase here a little bit in the future. So there's some complexity with that calculation and assumptions that you need to make. And like anything, you'll need to have those assumptions documented and be prepared to support those with your auditors and regulators. Another con in this is I've heard that it's just too simple a method. The calculation's not complex enough. You're not discounting cash flows. You're not considering repayments after something's gone in default and recovery. Yeah, your default and recovery, and so there is something to be said. There are shortcuts within this calculation to make it a little bit simpler and easier to digest. And if you're a large, complex organization with complex loans, it may not suit your needs. The discounted cash flow, this calculation is about as theoretically pure a way of calculating the CECL reserves as you could come up with. So the comment or question we had earlier about needing a PhD in economics, here you could probably use a PhD in math to be able to explain what all is happening behind the scenes, because there's assumptions that need to happen with the loss data that you're getting from your peers. But again, the beauty of this calculation, the discounted cash flow, using some of the main service providers that we've seen, it is straightforward. You can explain it. Everyone's heard of a discounted cash flow, and you start from the bottom up. You can use peer loss data, so you're not just having to rely on your own bank. You're not having to rely on banks that are $1 billion or greater. You can compare. You can pick actual peers that are similar to your organization, and it's much more sophisticated. These models have a lot of inputs, which is both a pro and a con. You can make all sorts of assumptions and make different assumptions for different loan categories, and come up with a very, very precise calculation. But it is more work than these other models, and depending on your institution, may or may not be warranted. Cons, it requires a lot of data. There's lots and lots of calculations happening behind the scenes, which are difficult. You can kind of see what's going into the box, and you can see what's coming out of the box, but it's difficult, even as an auditor, to be able to recalculate and come up with what's happening in the box, because there's so many numbers being crunched and some very complex math happening. The assumptions are numerous, so having good internal controls, you're going to have a lot of things being verified and documented on a quarterly basis of why did we pick this assumption, why is it still appropriate, are we sure this assumption is what made it into the model, et cetera, et cetera. And another con is you may have to rely on service providers for some of their proprietary data in the calculation. So not just your data or your peer data that's available publicly. A lot of the service providers also work in data that they've accumulated through their client bases to help make the calculation more precise, but it adds another element of a black box where you can't see through what's happening. Other approaches, like I said, we won't talk about these much. The one bullet point I will point out there, and it's probably something to consider for almost all of them, if you're using your own data and you're maintaining a lot of your data to be able to support your calculations, you could have additional costs with your core service provider. So just keep in mind, if the core service provider says, oh yeah, we can keep that loan loss history going back 20 years, they may be charging you quite a bit of a premium for that. So keep that in mind before you say, oh yeah, that sounds great. Make sure you understand what the costs are going to be.
Brian, I think you touched on a great point. In all these different approaches, within the standard, there's nothing within the standard that specifies a certain calculation. So it really is at the bank level to determine, the size, based on the size and complexity of the bank, and then, their loan portfolios. I mean, that's really going to be the driver as to the most appropriate approach. And the expectations, typically the larger you are asset size wise, typically more complex, you're going to expect maybe a more robust model and analysis that's done as far as the CECL methodology.
Exactly. And on all of these, it's critical that management understands what's happening with the calculation, because they do all have shortcomings, and so you'll need to know what those are so that you can properly address them. And I think we covered this thing through the talk. The qualitative factors are still important. They vary though, depending on which model you're using. They're still very important. They're not going away completely. However, a lot of these, especially like the discounted cash flow method, there's so much happening with the models. They're using the economic data that most of the qualitative factors that historically you would have worked in are being covered now and built into the calculation itself. So there's still a qualitative factor that's needed, but it was much smaller in the banks that I've seen that have used that discounted cash flow.
Hey, Brian, we do have a question here. We can maybe address this.
Sure.
One of the attendees asked, can we have an in excess amount in ACL? So essentially kind of an unallocated.
Well, you're the more experienced person here, but I'd say that you're similar to the other model. You could have an unallocated, and I think I wish I still had my. If you pull up the Fed's data, there are some banks that have a very small amount of unallocated, but I would say that the unallocated should be pretty small, because I don't know. I'm not sure what you would attribute it to. You're doing this complex calculation to come up with your reserves, and then you're saying, and I got unallocated, but what's it represent? So if I came across a bank that I was auditing with an unallocated, it would need to be pretty small, small enough that I didn't care about it.
Exactly. I think that's going to be, maybe a little bit more with the incurred. Maybe there was maybe a little bit more tolerance for a level of imprecision. But as we get into the CECL, I would agree with you. I think that the amount of that unallocated should really be pretty small, kind of fit into that immaterial quote unquote bucket, because that's at the end of the day, your auditor is going to sign off on that, or your examiner is going to look at it. More is better, is what the examiners typically will say, but you still, if you're doing a good job with your methodology, gosh, there really shouldn't be an excess there.
All right. So how do you prepare for your auditor or regulator? This slide just goes back to a lot of what I've been commenting on, that it's critical that you understand how the calculation is working, and what are the key components of your CECL calculation. You need to have good controls and a good process around the inputs that are important to the calculation. You need to understand how the calculation is working within the model, and then you need to have controls on the back end where you're looking at the output and making sure that it makes sense. And this calculation does pull in information that you maybe haven't used historically for financial reporting, and you can have some things like loans being in the incorrect category have an impact on your total reserve, and have a pretty material impact. So it just really depends what calculation you're using, and you want to make sure that you understand everything that's going in that could have a big impact, and that you've got your arms around it.
Yeah, I think that's the big piece, the output. I mean, at the end of the day, you're going to go through, a lot of gymnastics as far as this calculation, but you really got to take a step back and, does it make sense? As there's more peer information that's available out there, you're going to be able to maybe hone in on that a little bit better. But that, at the end of the day, you still need to be able to kind of do that sanity check at the end of the day and make sure that, what the output is does really make sense.
All right. This slide is just a bunch of key inputs, possible key inputs. We won't go into it. The whole point of the slide is to say that there's a lot of things going into some of these models, and management needs to be able to support what they're using for each of the inputs. And depending on the calculation, some of them are going to be more impactful on the model outcome. And I think it's important that management knows which of those inputs do have a bigger impact, so that they can be more precise in their thought process and documentation around those. This slide deals with our documentation expectations. With all these assumptions, make sure that you're getting it on paper so that when a regulator comes in or your auditor comes in, you can hand it to them and say, hey, Brian, yeah, here's the peer list that we picked. Here's why we picked them. Here was our range. These two we threw out because X, Y, Z. So who did you pick? Who didn't you pick? Why? And be able to explain it in a way that makes sense. Q factors, again, what's the Q factor meant to capture? You can't just say, oh, we added a Q factor because we weren't sure. So we added a Q factor on top. Well, what are you trying to capture? What uncertainty? What part isn't in the model? Yeah. Anything that's a key important decision within the calculation, or that's an input by management, or a key decision point within the model, make sure that you've got good documentation to support why you picked what you picked for that particular quarter, and that's being refreshed as you're calculating it on a quarterly basis. That brings us to the end of our materials. I don't know if there are any other questions, but if there aren't any other questions, or Darrell, you don't have anything else to add, then I think we can hand it back to Gary.
Yeah, I think we can kick it back to Gary.
All right, thank you guys. Again, make sure if you're needing some assistance on CECL that you're reaching out to your Eide Bailly professional. Again, this is something that we've got our eye on and definitely taking a look at. So make sure if you need some assistance that you do that. We are working with a number of institutions right now that are going through it, some lessons learned from all of that. So again, I want to thank everybody for joining us today. I want to thank our speakers, Dr. Kohl, Darrell, Lingle, and Brian Finley. Nice job to all of you. Appreciate you and everyone's attendance today. I want to thank you for your time and your attention. Remember to check out our November 4th, 16th, and 18th virtual Eide Bailly seminar series. You can register at eidebailly.com/bank seminar 2021. Make it a great day, and thanks for attending. I'll turn it back over to Amy.